Good morning. Hope everyone's having a good week so far. Gonna have some fun today. Be getting started in just under a minute here. Welcome everyone. This is Back to the Futures with me, Markets and Mayhem. Coming to you live Tuesday, June 25th, 2024. I do this in partnership with Bookmap to talk more about their software, how I use it. So we'll be focusing on that. I'm bringing that up on screen. It'll load in the background here, kind of get everything all synced up. But first, let's just go through a couple quick slides as we get everything started here. First, everyone's favorite slide, and that is the general disclosure. All Bookmap Ltd materials, information, and presentations are for educational purposes only and should not be considered specific investment advice nor recommendations. Trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. So let me talk a little bit about myself for folks that aren't familiar with what I do. My trading journey began really in 2005. I did some of my first trades in the 90s, but I kind of don't really count those because it was just really two trades. It was Amazon and Yahoo. They basically doubled the next day and I got out. And then I took the next, let's call it 8 years or so to really learn how the markets work, get a better sense before I came back in with my own money. Back then I had been earning, but I borrowed money from my dad and used his account because I was too young to trade on my own, right? So I went out in 2005 with my own money and with some years of gained knowledge, watching the markets, observing, understanding more, because quite frankly, and there's some relationship between then and now and some of the crazy stuff we're seeing, I didn't understand how a stock could double in a day, let alone two, essentially double in a day. And that why would people work a job if all you had to do was kind of put your money in this magical machine, it would double, come back out, and you're good to go. So my young brain couldn't comprehend that. It just didn't make sense. So I had to get out. And when I saw the dot-com collapse follow, it actually made a lot of sense. I was like, okay. So people were getting way ahead of themselves. They were getting greedy. They were getting euphoric. They were getting excited. And people were just sort of piling over each other to make sure they didn't miss out on this perceived gain that was going to happen, right? And so that clicked. And that was what clicked in the risk management part of my brain. The most important part of a trading system is managing your risk so you have capital to come back to tomorrow, next week, next month, next year. So I navigated through the great financial crisis, talking about risk management, talking about liquidity. Wow, that was quite an experience. There were some really great trades I had. There were some really terrible trades I had. But what I did gain a lot of from that whole experience was the interconnectivity between momentum and macro on longer time scales, the importance of liquidity and how it can defy what you're seeing in the economy, and really just the appreciation for letting price lead. You can have an idea, you can have an opinion. That's fine. We all do. But you can't really trade off of it unless there's some kind of momentum there, unless there's some reason to say, okay, this is a valid trade. It's not just an idea. So my approach, because of all of that formative experience, became systematic. I wanted to really remove emotion from the process here and become much more driven by my own way of defining these variables. Where are there areas of opportunity? Where are there areas to stay away from? And for me, opportunity was momentum in earlier stages on swing timeframes, like a reversal or a breakout. I didn't want to necessarily capture the absolute low or, call the absolute top. I wanted to try to capture the momentum in between. Because what we learn time and time again as traders is that's the more reliable way. It may not soothe the ego the same way. We can't go around saying, I called the bottom, I called the top. But trading isn't about ego. It's about making money. And making money consistently means A, being able to accept that we're wrong and not staying wrong for long, right? But also means being able to get into some of these trades where we might feel like we missed the boat, even though the boat's just getting ready to leave the dock. And that's those momentum trades. You say, oh, geez, I missed that bottom. It was so obvious in hindsight. Well, dips can keep dipping. Why not let the institutions do the heavy lifting for us? And then we can get involved and maybe we miss 5 or 10%, but we get to try to capture that momentum between where we get in and where the move ultimately stops. So momentum is a big part of my process, looking at price action, volume profile, options flows, and of course the big picture or macro. Macro matters. It matters over longer time scales though. And that's something that's really important to appreciate. Like if you see a data print and within 5 minutes the market hasn't reacted to it and the conclusion is macro doesn't matter, I would hesitate away from that view. I think it's longer time scales is where this thing, this type of theory, these types of plays can become more relevant, right? And one could say, but macro didn't matter in 2023. We fought the Fed and we won. Well, the reality is, while the Fed was doing their best to tighten policy, the government was spending aggressively on the fiscal side. We're at a point now where deficit spend is the highest percentage of GDP with unemployment this low ever. So the government fought the Fed and what? Not the market really as much. And so macro still mattered. Arguably, it's really important to understand that top-down series of themes and trends that are driving price discovery. I began working with Bookmap in early 2022 because I saw great value in the way their platform displays market data. And I mean, looking at this from a newbie's point of view, a neophyte's point of view, right? It's complicated. It's different. I understand that the charting system confuses some people. So we're going to dive into that so we can get to the, sort of basics of reading the charts on Bookmap, make it easier so you can understand what you're seeing on screen. Because yeah, it's not a line chart. It's not a bar chart. It's not a candlestick chart. It's completely different, but I find it more valuable for short time frames. I also built a tool that sits on top of Bookmap called the Advanced SPX Options Visualizer because SPX is the biggest options market in the world. It trades a lot more notional than futures. So there's about 1.2 trillion of notional value trading in SPX alone every day. And that's beyond the equity futures market, where about 400 billion of notional trades across all equities futures. So you could see the tail is wagging the dog in terms of how options can influence the market. And that's where this tool can be valuable. And you combine it with being able to visualize liquidity, order flow, where there's interest in price in Bookmap, where there's icebergs and stops, and some of the other nuance I've added in with the way I've configured it. And it ends up being quite valuable. It was quite helpful yesterday to catch the sort of, implied high by that most active call strike, for example, something I posted about on social. So here's a little bit about how to follow my work, and then we're going to go right into Bookmap. You can follow my posts on Twitter and videos on YouTube. Same name, Mayhem 4 Markets. That's Mayhem number 4 Markets. My trading ideas, coaching, and unique market tools can be found at TraderAid.com. You can also get up to 40% off of Bookmap at TraderAid.com/Bookmap. Just scroll down to the bottom where the specials are. And the advanced SPX options visualizer that I built for Bookmap is available on their marketplace. If you want to learn more about it, visit TraderAid.com/SPX. And my long-term trading and investment ideas, research, and institutional consulting services are available at macrovisor.com. And I live stream regularly, including for Bookmap every Tuesday at 9 a.m. Eastern for an hour. So be sure to join me. Set your calendar. Let's have some fun. So we're going to dive right into Bookmap here. We have that on screen. And as we're kind of switching things up to get into this Bookmap view, as you all have questions, please let me know. I am happy to address them. I want to make sure that everyone gains something from watching this today. Whether you're new to Bookmap or whether you've used it in the past, I think either way, this stream can be beneficial to you, because we're going to talk about how I'm using it, how I see, opportunities emerge, and we're going to look at futures, we're going to look at stocks, and we're going to look a little bit at crypto as well. And it's cool because there's, a lot of different ways to visualize this data. And depending on what package you get, you can also backfill up to 72 hours of trading data, which can be helpful for those sort of longer time frame day trades, like a day trade that may go on for several days or the entirety of a day. Backfilling that data can give you a little more context on the price action as well. We did get some house price data as I was talking, as the stream was starting. Not too much to go off of here. Home price index rose lower than expected for April, both year over year and month over month. So on screen, you will see the Bookmap application. And what you're really seeing is a visualization of market participation, both past and present. And it's illustrated in a number of different ways to try to add some value, and also that redundancy can kind of reinforce some of these areas and their importance. So everything to the left of this vertical white line is the past. And that's a time scale that you can adjust. You can take your mouse to the bottom and you can drag. So you can fill in more of that past. Like we can see from the European session, we've had a mild bid in the S&P by just dragging that out to about 4 a.m. You can also change your price scale. This, for whatever reason, if you want to zoom out, see where there's resting bids and offers, you can do that. You can also zoom in very close so you can get a sense as to the microstructure and that price action. And you can change not only your time scale by using the bottom bar to zoom in and out, but you can also use time slices. So if you have a defined time slice that you prefer to view, that's another thing that you can do using that time slices option. I personally prefer 30 minutes for most of my viewing. So that's how I do it. I go in, I select 30 minutes. It gives me that 30-minute time slice, and I can see that period of time on screen. Now you might be hearing some of that pinging here. This is part of the ES aggression indicator. This is Market Pulse. I've modified it a bit to really just show the most aggressive volume pressure for the S&P 500 E-mini futures contract. So that means it's above 90% or below minus 90%. That's where that threshold's reached. And that gives me both a visual indicator in this radial and on the bottom of the chart here. You can see that very light green and light red line, and then that darker red when it reaches an extreme, or that darker green when it reaches an extreme of buying pressure. that all gives me just a sense as to what's happening, right? So if I'm not watching this screen, because I don't stay glued to my charts the entire day, I'm looking at several different screens. Truth be told, I have 6 different screens in front of me at any given time. And that doesn't mean everyone has to trade that way. You don't need that much. I'm not just trading. I'm researching. I'm writing content. I'm watching different, news develop. I'm coding and so on and so forth. So, these are not all trading centric screens, but nevertheless, that audio alert, you can hear it. That draws my attention to the chart. I like having those audio alerts in Bookmap because it gives me a reason to pivot over to that chart and say, oh, what's going on there? So I have audio alerts specifically focused on S&P because it really is the center of the market. And it's where a lot of those trading flows, both in futures and options, are happening. You can see the difference here. And we'll put this on screen here. I typically have it on screen anyway. This outside liquidity, you can see pre-market order book depth about 45,000 on S&P when you add up above and below price. When you look at NASDAQ, it's a lot lower, right? It's about 7,000. So that tells you that NASDAQ, even though it's a very important index with a lot of key stocks, the futures are a lot less liquid than the S&P. So that's another reason to really watch the S&P because it is the center of the market. So I have alerts set up for the S&P when there are events that warrant my attention. Another one is unusually large icebergs and stops. I don't want to know about every iceberg and stop, so I don't show them on the chart and I don't hear them. I only show and I only hear the ones that are more extreme. Now, why do I do that? First, because I have the subchart and the radials to do that sort of accumulation. They'll show me incrementally or decrementally what's happened over that 30-minute time slice. So I don't need to have that all kind of clogging up the main chart. I also don't want to hear about all of them on the audio because it becomes a bit much. However, if you're reserving your audio alerts and your visual alerts for more noteworthy events, they stand out and they immediately give you a sense as to their relative importance, right? So when I'm using icebergs on Bookmap, I have a very specific way of configuring them. I'm using a 30-minute interval because that gives me a reasonable slice of time, right? Looking back 30 minutes, looking at the kind of order flow we've had, that's a decent sample. 20 minutes I found to be just a little bit too short. 60 minutes is just a little too long for me. So my testing has indicated 30 minutes for ES and then a 10 standard deviation multiplier. Now, why do I want that high? Because I really only want to visualize the icebergs that could be market moving, that could be more important on the chart, right? The other thing is I do get rid of the filtered icons. By default, you show the filtered icons. They're kind of, in the background, semi-transparent. I don't need that either because, again, it kind of clogs up the visualization. So I like to have just what's shown on screen be important enough to warrant my attention on the main chart. Then I will also change the buy and sell colors. By default, the icebergs are just blue, which is fine. But for me, I want to be able to look at that iceberg and know, was this a buy? Was this a sell? What was the size of it? I also increased the size of the icon a bit, right? Just to make it stand out a little bit more. And then for my stream on the Discord, I have sound alerts set up as well, which you can do based on thresholds, right? So typically I'll use a 2000 iceberg threshold for ES. Now you have to size your threshold based on the liquidity of the instrument, the kind of volume it has. If you were to use 2000 on, say, 10-year note futures, you're going to get tons of alerts because it's a much more liquid contract. The order book depth is often hundreds of thousands. So the trades are often in the thousands. So you got to size your alerts, whether it's iceberg stops, large trade alerts, whatever it might be, based on the size of the order book and the kind of volume that trades, right? It's all relative. So stops, I do something kind of similar to icebergs, right? I have this 30-10, so 30 minutes, 10 standard deviation multiplier. I only want to see what's most important. I really don't want to be bothered with, a lot of the other stuff that's happening there that's smaller size, because I found in my own experience, it has less of a market impact. And also I'm tracking it in the radial and the subchart, so I don't necessarily need it on the main chart as well. I also color code my stops red and green, just like I do the icebergs, so I have an idea whether they're sell stops or buy stops. I make those icons larger. I get rid of the filtered icons because, again, I don't need all that on my screen. And I only show stop runs because I really only want to see that kind of, that kind of move. I'm not quite as concerned about the smaller amounts of stops that don't have a bigger price impact or aren't happening when there's a larger price impact. So that way I get an idea of, where there might be an exhaustive stop run before a reversal. Just like with the icebergs, I get an idea of where there might be more aggressive absorption of sellers or buyers that might help to tell us, hey, these smaller traders are getting stopped out. They're having to sell, but you see these icebergs absorbing it. Sometimes you can have that take place before you see a reversal in price action. So stops and icebergs, I'm pretty specific about how I configure them because I really want them to give me, I think, just greater signal on the main chart, right? Now, this is based on how I trade. I don't take a ton of day trades. I really try to reserve it for where I think I'm going to be able to pull out maybe 10 or 20 handles from ES or more. So I'm a lower frequency, higher conviction trader. That might not fit everyone's style, but that's why I configure things the way I do. I have outside liquidity set up, so that shows, as we talked about the order book, and I am showing everything, right? And the reason I'm doing that is because I want to get a sense as to how liquid the market is at a glance. If we get into the trading day and this thing has less than 50,000 contract order book depth, or even really less than 60, I look at that and I actually get a sense as to how I want to size my positions and how I want to place my stops. There is a pretty strong correlation between volatility and a lack of liquidity, and a lack of volatility and an abundance of liquidity, right? That is to say, there's an inverse correlation between volatility and liquidity. If liquidity is lower, that increases the chances of larger moves. It takes less volume to move price. So in that distribution of tail risk, to me, that means I need to size down and use wider stops. It also means I need to be even more discerning about what trades I'm willing to take. So that's one of the reasons that I look at order book liquidity and I track it in every instrument I trade. So I get a sense as to when it's healthy, when it's low, and how that impacts my approach to trading that instrument. I also use the liquidity marker. This is pretty handy. And I actually like to show 249 and up. Sometimes this gets reset when you roll the contracts, but 249 and up, what that's doing is it's just showing me, where there's interest in the order book and where it's large enough to warrant my attention. So you can see that 291 up there. As the market opens, you'll see more of those labels pop up. We'll probably get to a more liquid order book as well post 9:30. So I sort of reserve my overall judgment as to what is the order book liquidity until first 10 or 20 minutes of the trading day. The other thing I do is I like to look at the 20-minute opening range. And so I do have these indicator lines you'll see on screen, the highest price and the lowest price. This helps you track the opening range, whatever time frame you're trading, whether it's 30-second, 2-minute, 5-minute, 10, 15, 20, 30, an hour. You'll get these lines showing you whether you've made a new high or a new low. And I have it set up so they reset at 9:30, okay? So it's a pretty easy way. So I don't have the mid-price level. I use the point of control because that's what I'm more concerned about. But I have the highest price and the lowest price. And I reset it every day at 9:30 Eastern. Okay, so when the market opens and we get to the regular trading hours session, my high and low prices reset so that way I can track the opening range. Really easy way to put this to use. It's really handy in my opinion. And that's another plugin that, you can grab. I'm pretty sure it comes with most versions of Bookmap. And it's simplistic, but it does everything you need to track that opening range. And then after you've figured out, okay, here's the opening range, whether we're breaking above or below, if you're in a trend day, you're also able to track whether the price is making new highs or new lows as you see price interact with that high and low line. So it can be helpful. It's very simple, but it can be a helpful tool just to have that visualized on screen. Now on the heat map, you can see the amount of past interest and then present interest, right? So red is a level of higher interest, and it's relative to its proximity to price as well, you'll notice. So that's another thing that's important. Like you'll have this level 209, you'll ask, well, why isn't that really dark red? That's because it's further away from price. So proximity to price also impacts the coloring of the heat map. But general rule of thumb is, red is a pretty high area of interest. And as we get into the trading day, you'll start to see this, become more liquid. You'll see more of these areas appear, and you'll also get a sense as to where there's interest in price as to where liquidity builds, whether it's more above or below price. Often is the case as that liquidity builds, say, for example, above price, it can act as a magnet. But if price gets rejected rather than filling those orders, that tells you there's not enough demand. And by the simple rules of a sort of three-way market auction, often is the case that price will reverse lower. So it's very important to understand and observe how liquidity interacts with price as well, right? If you see price run away, that's generally a sign that there's not enough demand or supply to get through that area. On the other side of it, if you zoom right through and you see these larger delta bubbles start to build, that tells you there's some conviction that could build on a larger move. And that's exactly what these are. These are delta bubbles. They show you the difference between buyers and sellers at a given point in time. So it's different than a candlestick. It's different than a line chart or a bar chart. I find it quite helpful for intraday trading. I've also gotten rid of the best ask, best bid line that kind of ties them together, because to me, again, I like simplicity on my screen. So I've really optimized it, just like I've optimized the coloring of the heat map, what stops an iceberg show, and etc., to really just focus on what I find to be the most important at a glance data. Because as I mentioned, I'm not necessarily staring at charts throughout the trading day. I find it's very important to have my eyes and my attention in multiple different areas, and that's why audio alerts and then visual notifications on key events help me really navigate the market more effectively over multiple time periods. So we're about 3 minutes away from the start of the US trading session here. Ahead of the open, S&P cash index implied to rise about 0.25%. NASDAQ about 0.5%. The Dow 30 implied to open down about 0.13%. And the Russell 2000 small cap index implied to open down about 0.25%. Now, an interesting thing that I want to remark on that's sort of separate from this, but important for us as traders, is how positioning can impact price outcomes on certain days where there are big moves. For example, NVIDIA is a hedge fund favorite, and we can see why. The stock has returned a lot for investors, and that means you get folks that are momentum chasers, really long names like that. There's a lot of concentrated long positioning in hedge funds among the so-called Fantastic Five, which includes other companies in addition to NVIDIA like Microsoft, Alphabet, Amazon, Apple. Nevertheless, what's important is when you have a leveraged long book and you're really concentrated these growth favorites and they go against you, particularly NVIDIA the last 3 days, you have to usually lighten up some of that positioning and then degross on the other side, the short side of your book, right? So imagine yourself as a hedge fund, you're long the Fantastic Five, and in order to reduce your overall exposure to downside risk, you're shorting the Russell 2000, right? Just as a simple example, but this actually is relatively accurate based on the kind of positioning we see. So when your longs are getting smashed, your risk manager taps you on the shoulder and says, hey, you need to lighten up your book. So that means you need to sell some of your Fantastic Five. It also means you need to buy back some of those shorts against the Russell. Why do I mention this? Because yesterday we saw, NVIDIA getting smashed, and then as the day went on, NASDAQ bleeding lower and lower, particularly into the close. And we saw at some points the Russell was showing relative strength, and some were suggesting that this was a rotation. I don't think that's the case, and it's so important to understand the positioning that can drive these types of flows. Because if you look at it from the context of hedge funds downsizing near record gross leverage, and that's the other part that's important, they're like record levels of gross leverage. What that means is they're going to sell down some of that Fantastic Five exposure, right? Particularly NVIDIA, because that was really working against them. And we can see that in some of the positioning. They've been lightening up on some of their semi and hardware exposure a bit, but it's very, very, very high. And on the other side, they'd be covering some of that Russell exposure, right? And so that would send the Russell up as the NASDAQ and some of these leadership stocks are moving down. So it's important to look at that sort of context as to why that dispersion may be happening, because it's not necessarily bullish for the small caps, where over half of the Russell is very rate sensitive and about 30+% of the names don't make money, right? There's still a very challenging environment for those more sensitive names. So market open is imminent here. Again, S&P implied open up about 0.25%. NASDAQ implied open up about 0.44%. We are seeing some selling pressure here at the open. We do have a market on open imbalance of negative 140 million on S&P, negative 56 million on NASDAQ, negative 32 million on Dow, and negative 26 million on the Mag 7. The biggest sells are Broadcom, Home Depot, NVIDIA, Bank of America, and Boeing in those imbalances. The biggest buys are Salesforce, Chipotle, Eli Lilly, ServiceNow. And so we see some of that market on open pressure. It doesn't always manifest. It always depends on what the other side of the trade is going to do. But today, just a little bit of a pull into that open. We're just sort of pinging that gamma flip level that the advanced SPX options visualizer shows. That means that as we're above it, dealers are more likely to sell rips and buy dips. That tends to compress realized volatility, tends to stabilize the market. The market tends to be more constructive in its price discovery when it's in a positive gamma dynamic. When you move below that gamma flip level, particularly 10-20 handles below, you start to see more volatility. Dealers are more tempted to sell dips and buy rips. That exacerbates realized vol. You also see less constructive price action regimes in negative gamma territory. So how we interact with this flip level and sort of where we go from here will be important. That level right now seems to correlate with 5450, which is also a large area of options positioning on the SPX options chain. Now, this is all shown by the SPX options visualizer plugin I created for Bookmap. It takes all this data, recalculates it every minute throughout the trading day. It also shows these live flows as they're happening, and those will update. These are yesterday's flows. I keep them on because they can be helpful, but they'll update to today's once we have enough volume in the CBOE trading of SPX. So again, you see those larger red delta bubbles, right? That does illustrate there is some conviction here behind the selling. You also saw a resting bid emerge here just at yesterday's hot put or most active put strike level. Those are SPX levels converted to ES, right? So I calculate the delta and I convert that so that we can put it on screen and make it relevant to what we're seeing, even though they're basically trading in two different worlds. The futures are looking ahead. This is the September expiration. The cash index is, real time. Now that liquidity, that bid down there, does tend to be a bit magnetic. So it will be interesting to see how we react to that. As we discussed earlier, the reaction function is really what matters. We're in the first 2 minutes. We have not seen order book depth increase. We're still at about 47,000 there. So we do want to see that increase if we want to have a healthier trading environment. I really like to see it above 60 and at least above 50. Nevertheless, I do think it'll be interesting to see what happens down here. We see some of these resting bids now moving lower. So that resting bid was pulled and moved lower. You can see that on the heat map here from the past liquidity to where we are in the present. Now let's check around some of these other markets here. We've got the NASDAQ. That is quite volatile over there. Look at that chop. Woof. I like to call it the high beta beast. That lack of liquidity in the order book certainly helps to feed that and make that name more accurate. Let's take a look at some of the leading stocks in the NASDAQ as well. Everyone's favorite, NVIDIA here. Little sell at the open, but largely just chopping sideways. Microsoft getting a bit of a sell here from the open. Some decent selling pressure here right at that open. You had a pop and then a drop lower from there. Apple, nice little drop and pop at the open. Got a lot of liquidity overhead in Apple. It'll be interesting to see how it reacts to these. Amazon just sort of chopping sideways, brief pop at the open, then started to run away from that overhead liquidity, which can be a little bit bearish, but it's not something I would put a strong reading on in the first 5 minutes of trading. So we're just looking at these more to get a sense for how trading is taking shape. Google, nice little pop and drop here on the name off the open. Meta, similar look here. Drop and pop. Pretty good pop in Meta so far. Almost up 1% from those lows. Tesla is just sort of chopping sideways. Popped, dropped, again. Made a new low. This one has been quite volatile of late. Lots of mixed opinions about the company's future. And then everyone's favorite meme stock, GameStop. Can't take my eyes off of it because of this just sort of morbid curiosity. But it just doesn't seem to be able to catch a bid again. You had management dump, large offers. Both times there was a decent move in this stock, and it's given a lot of those moves back. And there really isn't the type of short positioning we had during the GameStop rally in 2020 and 2021 to power it higher. And on the other side of that, there was until recently, really lopsided call skew. That's worked itself out a bit. So maybe traders will give this thing another run into the summer, but I'm careful of these meme stocks here. These things often end quite poorly. A lot of these short covering events tend to end quite poorly. Let's look at the Russell. Russell smacked down at the open, tried to catch its bearings here, just sort of consolidating after that drop. And across futures, we do see just a little bit of upward pressure on rates as well. And the Russell tends to be quite rate sensitive. Copper here, just sort of consolidating. We're going to pull this back a bit, though. It's been just a mess. And copper is a commodity that's had a bit of a struggle. If you think about it, when we are over $5, the premiums in COMEX copper were completely blown out versus Shanghai and London Metal Exchange copper. The sort of backwardation we were seeing was extreme. It was more extreme in the US than anywhere else. Those premiums kind of suggest that as well. And then long positioning was super concentrated. So we got to an extreme in copper. We're seeing this pullback. It's corrective. It's healthy, although it is quite sharp. And we also have to contextualize one other key piece of copper. China accounts for over half the world's demand, and their economy is still in trouble. It's getting better on the export side, not so much on the internal consumption side. So I'm looking for copper to potentially pull back some more, maybe around 427 or so. I'm looking for that area to act as support, price to reverse, and then I may be interested in taking some positions long in copper and its miners again. Now let's go back and check on the ES contract, because we do have some sounds here that indicate more aggressive selling pressure. So we have made a new low here on ES. And we do see some of those bids moving lower again. We have a decent resting offer just above price, but what's more intriguing to me is you see these bids starting to stack below. So we're going to keep an eye on that as well. And right now, S&P cash index trading up 0.15%, NASDAQ up just about 1/3%, Dow flat, Russell 2000 down 0.43%. Cocoa continuing its collapse, really agriculture as a whole looking pretty bad. Lumber also continuing that drop. So seeing some softness in the softs, as it were. Let's take a look at rates, and I like to zoom this out because this is not a very volatile trading instrument. So from the European Open, you had a pop in 10s. You had some aggressive buying. It wasn't really enough to keep price up. Now we're making new lows, which means rates are pushing higher. That tends to put pressure on the small caps especially, and the longer duration growth tech stuff that's not profitable. Let's take a look at gold here. Gold down just about 0.4%. We'll pull it back to the European Open here as well. Sort of like rates, gold got a bid. Now it's selling down to new lows here. This is something that I've been cautious of for the past several weeks because it seems like the path of least resistance is to the lower end of this trading range. And should we break below it, and this is something we covered in the Macro Visor dashboard yesterday, and we've been well ahead of a lot of these moves in commodities. I got to kind of pat ourselves on the back a little bit that, you know, we caught them as they were in the early stages of their momentum on the buy side, and then we got out of the way before they started to roll over. For copper, gold, silver, energy, a lot of these different areas. And so we're still looking at gold and silver constructively over the intermediate and long term at Macro Visor, but we're a little more concerned about the near term. We're looking for this to level out, to consolidate, and give us another opportunity to get long on a swing time frame. So for now, gold is sort of in the hands-off box. It's in the penalty box along with silver, which is struggling a bit here until we see some more constructive price action. Energy overall, I'm constructive on, provided it stays above about $80.40. We are having a little bit of a pullback today, but the overall price action here has broken us out of a trading range, and I think energy stocks look even more constructive than crude, but both overall look pretty constructive here. And we've got natural gas. Natural gas more than doubled since I talked about wanting to get bullish of it in April. This pullback here makes sense that we've seen over the last week or two, given that storage levels are still above their 5-year max range. So it's really about how hot is this summer and what kind of events do we get in the Gulf that may disrupt production. Those are really the two key catalysts at the top level. And then the third is, does manufacturing continue to slow? Because that's a big driver for natural gas demand. Now let's check back at the S&P. We heard those pings. This is why we have them, because again, they give us a sense as to what's happening. So we had some more buyer aggression come back in. Perhaps we start to see a bit of a consolidation phase here. You can see price isn't necessarily making new lows. So let's see how we trade here. We got below that gamma flip level calculated by our naive SPX options model. Now we're starting to trade above the point of control, which was pulled down by sellers, and now above VWAP. We also see a bit of a passive seller just came in, dumped about 19 contracts, coming back in again, dumping one contract on this. And you can see on the subchart, icebergs going a little bit more negative. You can see that on the radial as well. So that's just a little bit of absorption of buyers coming in. And that sound tells you there is a little bit more aggression on the sell side. You did see the passive seller appear overhead. That order is still open. One contract process so far. And we've got about 6 minutes until we see that 20-minute opening range. But so far, not particularly inspiring. Just about 9.5, 8.5 handle opening range. So if that ends up being the actual opening range, that portends to a rather boring trading day. And then it's a matter as to whether we break above or below the opening range and build some acceptance as to whether there is even the probability of a trend day taking shape. So for now, it's best to watch, wait, see if we get something that gives us a higher probability setup. Like I said, I'm more discerning about how I take day trades, particularly in a low liquidity environment. Order book depth is only 48,000 contracts on S&P right now, so it's not a very attractive prospect. Let's take a look over at some of the leadership stocks. NVIDIA having a nice bid here, getting up to a pretty key level of resting liquidity around 122. We'll see if that area acts as resistance, but recently it has been making new post-cash session open highs. Tesla rolling over a bit here, rejected 182, which is a bullish short-term, very short-term, but nevertheless, not really getting much get up and go. Microsoft rolling over to new lows, not really matching the look we see in NVIDIA. Meta making new highs, taking out that resting liquidity at 503, really large level at 505 for the stock. But this one's really been one of the stronger performers after the open. Google just sort of consolidating here around 180.60. But looking a bit more positive than some of its peers. And Amazon just sort of back to where it opened. Not really a lot going on in Amazon. Or Apple, quite frankly. Apple consolidating has risen off the open. But it really looks like Meta is leading the way here, and NVIDIA is helping with that as well. Some of the others not as inspiring. NASDAQ, nevertheless, off its lows and recently making new post-cash open highs. You can see some of that low put in when we saw a passive buyer step in. It was kind of up and away, but now we're starting to see these passive sellers layer in on top, just around that top of the trading range. And we're starting to push down below the point of control. So still a little early to tell who's decisively got control of price action here. That's again why I like to look at that 20-minute opening range, especially on a day where liquidity is a little bit light, and it remains light. I ordinarily like to see things become a little bit more liquid by this time of the trading day. We're not seeing that, so it suggests it's sort of a summer doldrums, getting ready for the next set of holidays type of trading week. And of course, next week we do have Independence Day, so the 4th will be a holiday, so it'll be another shortened trading week. So a lot of folks check out, and you kind of see it in the way the market trades. So what that really tells you is you don't get as much decisive trading, you have higher potential for volatility, you have more junior traders and bots running the trading desks and the algos. And so, you can get these whipsaws. And that's something to be careful of, particularly if you're not an agile trader. You got to be careful about how much size you're putting on if you're trading this, because you can get moves that can be kind of wild in both directions, particularly if there's any kind of event volatility catalyst, anything that happens either scheduled or unscheduled. And this is a week full of Fed speakers, but also on Thursday we get GDP and quarterly PCE, and Friday we get year over year and monthly PCE. Now, those numbers, those PCE numbers, particularly on Friday, probably come in, lower than what the market is expecting. But the question really to me is going to be how much weight is put into that if the biggest discount is from energy. Given that energy prices have resumed their rise in June, many may look at that drop in May as a head fake. Now, the Fed's Bowman earlier today said they don't see any rate cuts for 2024. They've shifted their idea of cuts to 2025, and they've not ruled out the possibility of additional hikes. Personally, I don't think hikes are likely, but one of the things I find very interesting about all these Fed speakers is they never seem to acknowledge the role that fiscal excess has played in fighting the Fed, which would be convenient for them, because they could alleviate some of the burden of responsibility as to why Fed policy hasn't really worked by accurately implicating fiscal excess, because this is the largest amount of deficit spend as a percentage of GDP with unemployment this low ever. So it tells you right there as a mathematical certainty, this is aggressive. This is one of the reasons inflation hasn't gone away. And yet they don't seem to identify that. They sort of live in their own microcosm where the Fed pulls all the levers for the economy, and we know that's not true. 2023 and 2024 so far have been years that proved that wasn't true. That you can fight the Fed with the help of the government, with the help of fiscal excess that more than overwhelms Fed policy and eases financial conditions and reliquefies bank reserves. So just about 1 minute away from forming that 20-minute opening range, and we can see it's a rather sad opening range here. Basically 8 1/4 handles on ES. So got some questions in the chat rooms here. Do I think Nvidia may try to fill yesterday's gap to about 125, then come crashing back further? It's certainly possible. We're in the summer doldrums of trading, right? So you're going to have more whipsaw volatility, and you're going to have options potentially have an even bigger impact. The other thing we have is end of quarter rebalancing, right? Some of the big winners may be sold down a bit because you've got funds that need to rebalance their positions, and a position's got way too big for them. They probably need to size them down so they're the right percentage or the right weighting of their portfolio. I think that's some of what we've been seeing. I don't know that it's necessarily all of it, but the other side of it is, next week's a holiday shortened trading week. And with that in mind, you have more folks that are taking vacation into this, folks that are off to the Hamptons this week, less overall participation. We could see it in the order book here, only 48,000 depth in ES. So I would say the probability of unusually aggressive realized price outcomes is higher. So trading ranges can be wider, which is another reason why I favor, having more forgiving stops, being more decisive about what trades I take, and taking smaller size in this type of environment. Reese, you said every time you open up Bookmap, it tells you to get off the beta version. Tried reinstalling and updating, but no change. Join us on the Discord or email support@bookmap.com, or join us on the Bookmap Discord. Ask that question. I'm sure we can help you figure that out. It probably ends up that you have to kind of remove it completely manually and then reinstall it. But I want to let the folks that deal with this, more than I do, help you and make sure that you get sorted out. Gibbs says 100% the Fed should be calling out Capitol Hill's overspending. Thank you. I agree. I think it's really interesting, the contrast between the ECB and the Fed. The ECB's Lagarde has called out that fiscal excess. Now, obviously, it's different. They have a monetary union, not a fiscal union. So maybe they're more in a position where they need to do that politically, and it behooves them to do that. And maybe the Fed's position's a little bit different because they become more politicized first under Trump and then under Biden. So maybe they don't feel like they have the latitude to speak candidly about these things. But that would just be something to contextualize. So we've got our 20-minute opening range. It is a boring one. It's 8.25 handles on ES. That to me is a yawn fest of a trading day. So I'm not too likely to take too many trades in ES. And, you know, some of the best trades we ever take are the ones we don't make. So just take that into consideration as well. So the demo trader said, could you go over liquidity once more, how you read it? So the one thing that I want to just reemphasize here is order book depth, right? Getting a sense as to what it usually is, how it trades under those conditions, and then what it is at present and how that may implicate price discovery. Liquidity and volatility are inversely correlated. Low liquidity tends to bring about higher realized vol. I'm not talking about implied. I'm talking about what happens rather than what's expected. So low liquidity tends to bring about higher realized intraday volatility. High liquidity tends to bring about lower realized intraday volatility. Now, there's obviously exceptions to those rules. You have an event volatility catalyst, something unexpected happens, etc. All that goes out the window because, you know, the price action is driven by something material, something that's changed. But all else being the same during normal trading conditions, when your order book depth is low, you're more likely to have whipsaw moves. So when you look at the total order book liquidity in the S&P, you can see up above on the top right and down below on the bottom right, 24K on the top, 23K on the bottom. Add those together, you get 47K, right? 47K order book depth on the ES contract is low. And it's not like we're dealing with the roll anymore. We're not competing between two contracts taking the same volume, right? This is one contract that's the most actively traded. So we can't use that anymore and say, oh, well, that's why, right? It's this rotational flow. This is really just illiquid. And so for me, for ES, I want to see it trading, you know, above 50, ideally above 60 order book depth, 60K, to give me a sense that it's liquid enough that it's not going to be really whipsaw-y. That's a new adjective I just made up for the purposes of describing this. But really, I don't want to see order book depth this low if I'm going to be really taking on trades of full size. Because, and you can see the way price sort of whips around in this type of trading environment, it's just less desirable to trade when you have lower order book depth. And you can very easily qualify that. So the way I do it, I believe this is a free add-on, but it's outside liquidity, right? And you just set it up to show the difference, show the liquidity and the difference, right? And then also include the visible price levels. And then when you have that enabled and set up, immediately you get these indicators showing you the past liquidity and the present liquidity. And that makes it really easy at a glance to get a sense as to what's going on. And so at 10 a.m., we do have an event. We have U.S. consumer confidence from the conference board. The expectation is 100. The prior reading was 102. Later this afternoon, we've got the Fed's cook speaking because we need more Fed speakers, right? A constant rotation of Fed speakers speaking their mind, confusing us on what policy outcomes we may expect from them is always very helpful for us during the trading day. Maximum cynicism, maximum sarcasm with that. And then we've got a 2-year auction at 1 p.m. Prior bid to cover was 2.41. And then later today, Fed's Bowman will be speaking again about 2:10 p.m. So, you know, just a litany of Fed speakers, some other event vol catalysts. Consumer confidence can be important. What's most important is why it moves and by how much of a deviation versus the expectation we see. So if it, like, for example, let's say confidence drops a lot and it's because people are concerned about inflation. Generally, things like that are negative for the market. And it would be like if we're expecting 100 and we saw it 95 or lower. And the reasoning for it wasn't because it was concerned about a softening economy. That could be read as bullish by the market because that implicates lower spending. That implicates maybe the Fed coming around to cut earlier. But if it instead comes in lower, like context is key. If it comes in lower because people are expecting higher inflation, that's likely to be read as a negative for the market. So it's not just the deviation from what is expected should that arise. It's also why is that happening? Why is the confidence lower or in another case higher than expected? Let's say on the other side, you get a reading of like 106 And it's because people feel really good about the economy. That may be seen as a negative by the market because that's not good for the pace of decline in inflation, right? Because that could suggest that people feel good about the economy. They're going to spend, they're going to travel, they're going to kind of keep prices buoyant. So it's going to be about what number we get at the headline level, but also why we get that number and how much of a difference that number is versus the expectation. That's coming up in just about a minute, and that is why liquidity is drying up on the order book. And Jimmy Jab asks, are commodities available on your charts? Yes, Bookmap has commodities available. So, you know, we get, I was going over copper earlier. We've got copper continuing to decline. We've got gold on screen, also seeing it decline, a little bit of seller exhaustion there recently. We've got silver looking a little bit better comparatively speaking. We've got crude oil on here starting to come back up from its low. So yeah, definitely have all the commodities contracts that have futures on Bookmap. So it's pretty handy in that respect. I'm going to go back to S&P though, because we are expecting news imminently here about consumer confidence. I'm going to just launch the live squawk for this. So it should come over voice as soon as those numbers print. About 45 seconds away. Yeah, you're welcome. Happy to
Original
help.
Fed Composite Index out early at -10, which is lower than forecast -3.
And we are seeing this
10
make
seconds.
new lows ahead of the number. All that liquidity drying up. Got to be careful trading events for that reason.
Still waiting. 100 spot 4, 100 at spot 4,
Inline.
higher than forecast 100.
Yeah, in line is what I would call that. So probably not a huge price impact, but I'll drill into the data and get a sense as to what drove the reading. It is down marginally from the last month's reading as well. So folks that have tuned in, I want to thank you for tuning in. I'm going to keep the stream going, but I am going to close off the stream on the Bookmap YouTube and Discord, shift over to my YouTube, Twitter, and Twitch, and my Discord as well.
The average 12-month inflation expectations ticked down slightly from 5.4% to 5.3%.
So that's interesting, just seeing that tick down. But I want to thank everyone for tuning in. Know that the stream will keep going, but I'm going to shift it up. So it's going to be on my YouTube, on Twitter, and on Twitch, as well as my Discord. If you want to follow my work, visit Mayhem for Markets. That's Mayhem #4 Markets on Twitter or YouTube. My trading ideas, coaching, and unique market tools can be found at TraderAid.com. You can get up to 40% off of Bookmap at TraderAid.com/Bookmap. And the new advanced SPX options visualizer that I built for Bookmap is now available on their marketplace. Visit TraderAid.com/SPX to learn more. And my long-term trading and investment ideas, research and consulting services are available at macrovisor.com, where we just published a new article with 3 new investment ideas. One of them is free. Visit us at Macrovisor, check it out. And I live stream regularly, including every Tuesday for Bookmap at 9 a.m. Eastern. So be sure to join me. Be sure to check out Bookmap. They've got a great product. They've got a great team behind it. And I really find it invaluable for my intraday trading. So thanks everyone for tuning in. I will be switching over. The stream will stay live on my YouTube, on Twitter and Twitch, but I'm going to close it off in the Bookmap YouTube and their Discord as they have other content coming up.